This is Macro Horizons, episode 333, Picking on Powell, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 21st. The second week of the Extel Global Fixed Income Survey is now behind us, and there are only two more to go. We're hoping for support and five-star votes in the categories of U.S. rate strategy, technical analysis, fixed income, and short duration. We truly appreciate your help and feedback. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market started with a notably bond-bearish underpinning, which extended following the lower-than-expected core CPI figures, but was eventually reversed by the disappointing or downside PPI figures. In essence, the long bond attempted to break 5%, and that was, for all intents and purposes, met with a rejection. Now, this certainly doesn't mean that 30-year yields won't eventually revisit five-handle territory, but for the time being, we expect that this will continue to function as the upper bound of the range. Perhaps more importantly, within the details of CPI, there was clear evidence that tariffs are being passed through to the real economy. Specifically, core goods inflation, excluding autos, increased to the highest level since November 2021. Without question, this is evidence that higher tariffs are being passed along to the end users. The key categories in which inflation was relevant in this context came in the form of home furnishings, as well as apparel. These are clearly two import price sensitive sectors, and the market will now be looking at the next several inflation updates to determine whether or not this is a one-off price adjustment or if this will lead to the type of self-fulfilling inflationary pressure that would warrant a Fed response. If nothing else, the composition of inflation at the moment suggests that it will be very difficult for the Fed to justify cutting rates in July. But frankly, a July rate cut was already off the table. What is more important is how the evolution of the inflationary environment translates through into a move or another delay at the September meeting. It is important to keep in mind that June's core CPI number came in at 0.2, and on an unrounded basis, 0.228. So it's a relatively benign inflation figure overall. The Fed will also have the additional benefit of two further CPI reports, the July and August data, before making the September decision. Currently, the market is pricing in roughly a 50% probability of a rate cut in September, and frankly, that seems fair, all things considered. Once the market and the Fed has the benefit of those two additional inflation reports, the probability of a cut will either move to zero or be effectively priced in. At this stage, we're holding on to our 25 basis point rate cut call in September with an acknowledgement to the fact that both July and August CPI prints will need to be comparably as benign as June's. Now, that might ultimately be a difficult achievement to target, given that as of the 1st of August, there will be a fresh new round of tariffs that hit the U.S.'s major trading partners. At the end of the day, however, we don't expect that this will translate into the type of inflation that will warrant the Fed to consider hiking rates, as one would typically expect with inflation, but we're certainly open to the Fed delaying the next rate cut into October or even later in 2025. It certainly goes without saying that the cross currents of macro influences at the moment have added to volatility, particularly further out the curve, and the market remains very much on edge for the next input or social media post from which to derive trading direction.
Well, we got a softer than expected core CPI report, which was enough to make treasuries sell off. 10-year yields back within striking distance of 450 immediately in the wake of June's CPI report, and 30-year yields crossing that 5% level that we had been watching beg the question, why would softer than expected inflation data trigger a move toward higher yields? Ultimately, the explanation centered around the fact that on a component basis, there were several aspects of the inflation report that are starting to show signs of the influence of tariffs flowing through to goods inflation, and this in turn conjured the specter of a reinflationary acceleration. Following CPI on Thursday, that specter of a reinflationary acceleration was fueled by headlines that suggested President Trump was on the precipice of firing Chair Powell, an idea which was then walked back by the president himself just an hour later, saying that he has no intentions to fire Powell. But still, we see the curve moving steeper, with 530s now comfortably above 100 basis points, as the long end of the curve is becoming increasingly unloved by Treasury market participants.
30-year yields at 5% are a clear reflection of the lack of sponsorship further out the curve, although the bulk of the price action on Wednesday was centered in the front end. So while the long end might be unloved, the market is certainly infatuated with the 2-year sector. The bid for the 2-year sector follows intuitively in the event that there's any chance that Powell is removed as Fed chair, and perhaps even more practically, there's clear pressure by the administration on monetary policymakers to be easier sooner rather than later. Now, the most practical way to see this turning into a sustainable bid would be a scenario in which the incoming Fed chair still starts in the middle of May of 2026, but the rhetoric, i.e. the power of the quote-unquote shadow chair, would be such that the market effectively priced Fed funds down to 3% or neutral by the middle of next year, leaving it incumbent on Powell to begin the process, otherwise risk a dramatic dislocation in the front end of the market come the middle of next year. Now, we're not entirely convinced that this scenario will play out, although we are on board with what the Fed has already communicated in the form of the SEP, that the FOMC continues to expect 50 basis points worth of rate cuts between now and the end of the year. The combination of June's core CPI and PPI, however, suggests that September might be more of a challenge than perhaps an October rate cut. One thing is clear, and that is that July is certainly off the table.
And there's another outstanding question around the potential for either Powell to be fired or a shadow Fed chair to jawbone front-end rates lower even ahead of the official end of Powell's term next year, and that is the relevance of the C in FOMC. After all, while the chair's voice is the most important in terms of communicating the central bank's bias around the economy and the appropriate path of rates, it's not a one-person operation in setting the appropriate level of yields, and presumably, while we've heard from Bowman and Waller that they would also like to see rates lower, it's no guarantee that the broader committee, and especially those more hawkishly inclined on it, would be on board with immediately lowering policy rates as soon as their potentially new boss took office. So this introduces an interesting thought exercise where there's the potential for the chair to dissent against an unchanged policy rate decision at some point next year. It's also worth contemplating the timing and whether it's really worth it from Trump's perspective in terms of political capital to try and push through removing Powell from office, given that really the soonest one could realistically expect the Fed to lower rates would be September, and frankly, even under a new chair, it's probably unlikely that meeting would be the one we saw the first rate cut. So then we're talking about the two meetings at the tail end of 2025, and then the meetings in the first half of 2026 that could potentially see lower rates as a result of a new Fed chair. Obviously, the political gamesmanship around the situation can't be discounted, but in terms of an actual economic impact, it doesn't really matter if we get another 25 basis point cut in October, or if that doesn't end up happening until next summer. Long and variable lags and all.
Frankly, if the administration's objective is to keep 10 and 30-year yields lower, Being aggressive in lowering policy rates is the exact opposite of what one should expect them to do. Assuming the 10-year yields are comprised of forward growth and inflation expectations with a little bit of term premium and supply concern, it should follow that the more aggressive that the Fed is in fighting inflation, the lower 10-year TIPS break-evens and subsequently nominal rates should be. This dynamic seems to have been marginalized in the argument presented by the administration that because inflation is trending lower and stock prices are back to or near record highs, that the Fed should cut rates.
And to turn the discussion away from what we heard or didn't hear from President Trump this week around Fed leadership, going back to the CPI report, it was the strength we saw in subcategories like apparel and home furnishings that arguably have started to show the influence that higher tariffs are ultimately going to have on cost to end users. Yes, there is a rhetorical debate around whether or not it is truly inflationary, given that it's a one-time price shock and presumably tariffs are not going to continue rising on a year-over-year basis, but nonetheless, in terms of an impact on consumer sentiment and relatedly inflation expectations, it's exactly this dynamic and what it means for the state of the overall economy that is keeping the Fed more patient than might otherwise be the case, considering the forward risks around the path of realized inflation, but also inflation expectations that are going to undoubtedly be impacted by increased import taxes that are then ultimately passed on to the consumer. What remains to be seen is, from a departure point of a labor market that is still nothing if not strong, is if that's going to be sufficient to trigger a turn in labor market demand and a sharper inflection in the employment landscape, which, as the latest NFP print revealed, does not seem to be immediately at hand. But it's this balance between the risks to growth in the labor market, while also considering the upside potential for inflation, that the Fed is attempting to strike, all while coping with political pressure that it is currently under from the White House.
With the backdrop of all the challenges facing the current Fed, an extended period on hold certainly has managed to define 2025 thus far. While at the moment it's certainly difficult to envision the Fed not cutting at all in 2025, that is a scenario that many, as recently as 2 or 3 months ago, suggested might ultimately be the case. This would require several things to occur in the real economy. First, we would need to see some of the tariff-related goods inflation broaden out in terms of categories. Said differently, as long as the inflation running through the system this summer is limited to goods inflation and focused in categories that are heavily influenced by tariffs, then it's easier to dismiss those as one-time price adjustments that are simply isolated pockets of inflation. This is made doubly true in the event that service inflation remains benign or even drifts lower. It certainly isn't out of the question to ponder a scenario in which downward pressure or moderating pressure on OER, rent, and service inflation overshadows the upward pressure resulting from tariffs. In such a scenario, we're assuming that the Fed looks through goods inflation and instead focuses on service inflation. That's a recipe for a September cut. Now, in the event that we see that broadening of inflationary pressures into the service sector, into the supercore measures, and potentially even into rents and OER, that would be notably more troubling for monetary policymakers and push rate cuts further and further out into the future. The wild card in all of this, as you point out, Ben, is what happens in the labor market. The administration's immigration policies have presumably taken out some of the upside risk for headline non-farm payrolls, while simultaneously risking labor scarcity in certain sectors of the real economy. We'll be closely watching average hourly earnings as the feedback loop between nominal wages and higher prices is the one that the Fed is and should be most concerned about. Tariff or trade war related isolated one-time price adjustments are unlikely to raise to the level of requiring a true monetary policy response.
And so, with the milestone price action of the week just passed, this begs the question of whether these bearish impulses and the risk of that wage inflation spiral that you touch on, Ian, combined with higher term premium as the result of potentially a more dovish FOMC going forward, has that made its way fully enough into 10 and 30-year yields at current levels to start to bring in buyers, given that the consistent refrain we've heard from our clients this year has been a lack of enthusiasm in owning the longer end of the curve at lower rates? Well, now we have higher rates, and so it remains to be seen if enough has changed in terms of the macro backdrop that the buy targets we had heard discussed earlier this year ultimately play out in terms of the price action. Obviously, 4% 2s, 450 10s, and 5% 30s have emerged as battlegrounds in terms of a test of the bearishness, and what is really in question is whether the potential upside inflationary risks, combined with a dose of supply-driven angst, even though we're not expecting coupon auction sizes are going to start growing until the middle part of next year at the earliest, is that enough to reaccelerate the term premium debate and once again push yields to a new higher plateau? Or has the global growth outlook cooled enough, combined with lower policy rates in other places outside of the US, to start to bring in larger end-user demand to treasuries at these levels? All else equal, we'd sort of start to think so, with yields back this high and no shortage of angst around the labor market, the geopolitical situation, and overall growth adding to the attractiveness of treasury yields that are unquestionably high in any context over the past several decades.
Well, one thing that's for sure, Ben, is that the level of angst here on Team Strategy is certainly running high. Still time to vote? In the week ahead, the Treasury market will continue to digest the implications from the series of inflation prints and the update on consumption. At issue is the extent to which the Treasury market can continue to hold the prevailing range, or whether or not we're overdue for either a material leg higher in longer-dated Treasury yields or a shift lower in rates. All else being equal, while we might be open to another round of selling pressure, at the end of the day, we still believe that 10-year yields are going to end 2025 with a 3 handle. So that might be slightly below 4%, but the path towards normalizing forward inflation expectations, combined with the Fed resuming the process of rate normalization, should contain the degree to which yields can back up from here. Now, it's notable that the supply story has taken a backseat, and we think appropriately so. Bessent has made it abundantly clear that he's going to be utilizing the front end of the market to fund the deficit spending that's been agreed upon by Congress. Now, eventually, the Treasury market should expect nominal coupon auction sizes to increase. However, at the current pace and given the borrowing needs already outlined by the Treasury Department, we don't expect auction size increases further out the curve will be on the table until the second half of 2026. As a result, we'll argue that we're past the peak deficit, peak supply anxiety period, and instead we'll rely once again on the global fundamentals. One of the arguments toward higher yields in the current environment has been effectively a contagion from other sovereign borrowing markets. Not only has there been upward pressure on longer rates in the UK, this has now become very evident and very topical for the JGB market. The results of the election out over this weekend will be reasonably closely followed in Tokyo, the trade being that if the current government is removed, that will be seen as a bond bearish signal. Now, it goes without saying that trading geopolitics has been a challenge, if nothing else, over the course of 2025, and we're somewhat wary that the market is over-indexed, as it were, to this as a key risk. At the end of the day, we do expect that it will be the U.S. fundamentals of growth and inflation that will ultimately keep rates contained and leave the Treasury market in a yield range that falls into the category of all too familiar. The week ahead also contains insight from Chair Powell, which will undoubtedly be followed by comments from the potential replacements for Powell when his term expires in May of 2026. The notion that a shadow Fed could influence the current Fed chair seems to have taken root, and we have heard more and more chatter, not necessarily about a shadow Fed having a direct impact per se on Powell and the FOMC more broadly, but rather creating the risk that the market has focused on the June 2026 FOMC meeting to effectively bring policy rates squarely back to neutral, or 3%. In the event that such expectations become the norm and are priced accordingly in the futures market, there's a case to be made that to avoid such a dramatic shock, the current FOMC, including Powell, could choose to err on the side of normalization, even if some of the key subcomponents of the inflation complex end up being stickier than anticipated as a result of the trade war. This is yet another moment in which we are happy that we're not the Fed chair. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as one settles in to complete this year's Extel Fixed Income Survey, please remember that a vote for Macro Horizons will not necessarily be interpreted as an endorsement of our jokes. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.